The Efficient Frontier introduces one of the central concepts of modern portfolio theory within the program. The Efficient Frontier represents the set of portfolios that provide the highest expected return for each level of risk, or equivalently, the lowest risk for each level of expected return. Investors seek portfolios on the Efficient Frontier because any portfolio below it is considered inefficient, offering either insufficient return for its risk level or excessive risk for its return. The Efficient Frontier is constructed by combining assets with different expected returns, volatilities, and correlations. This concept demonstrates mathematically how diversification can improve portfolio efficiency and help investors achieve more attractive risk-return trade-offs. The topic explains that portfolio diversification is the foundation of the Efficient Frontier. By combining assets whose returns are not perfectly correlated, investors can reduce overall portfolio risk without proportionally reducing expected return. Diversification benefits arise because fluctuations in some assets may offset movements in others. As more assets are added to a portfolio, unsystematic risk declines significantly. The Efficient Frontier identifies the optimal combinations of these diversified portfolios. Portfolios lying below the frontier are suboptimal because other available portfolios provide either higher returns for the same risk or lower risk for the same expected return. Rational investors therefore prefer portfolios located directly on the Efficient Frontier. A key concept associated with the Efficient Frontier is the minimum variance portfolio. This portfolio represents the combination of assets that achieves the lowest possible portfolio standard deviation among all feasible portfolios. While the minimum variance portfolio minimizes risk, it may not maximize investor utility because some investors are willing to accept greater risk in exchange for higher expected returns. Portfolios positioned above the minimum variance point on the Efficient Frontier generally offer progressively higher expected returns accompanied by higher volatility. Investors choose among these efficient portfolios according to their individual risk tolerance, investment objectives, time horizon, and financial circumstances. Thus, the Efficient Frontier serves as a framework for selecting portfolios consistent with investor preferences. The topic also emphasizes the role of correlation in shaping the Efficient Frontier. Correlation measures how asset returns move relative to one another. Lower or negative correlations produce greater diversification benefits and shift the Efficient Frontier upward and to the left, improving risk-return opportunities. When asset correlations are high, diversification benefits diminish because investments tend to move together during market fluctuations. Consequently, portfolio managers seek assets with low correlations to improve efficiency and reduce overall portfolio volatility. This principle explains why diversified portfolios frequently include different asset classes such as equities, fixed income, real estate, commodities, and alternative investments rather than concentrating capital within a single market segment. Investor preferences are incorporated into Efficient Frontier analysis through indifference curves. Indifference curves represent combinations of risk and expected return that provide equal utility to an investor. Risk-averse investors prefer lower-risk portfolios and therefore select points on the Efficient Frontier closer to the minimum variance portfolio. Less risk-averse investors may choose portfolios farther up the frontier with higher expected returns and greater volatility. The optimal portfolio for an investor occurs where the highest attainable indifference curve is tangent to the Efficient Frontier. This interaction between investor preferences and portfolio opportunities forms the theoretical basis for rational asset allocation and personalized portfolio management strategies in modern investment practice. Overall, topic demonstrates that the Efficient Frontier is a powerful analytical framework for understanding diversification, portfolio optimization, and risk-return trade-offs. By combining assets with varying expected returns and correlations, investors can construct portfolios that maximize efficiency and improve long-term investment outcomes. The Efficient Frontier, minimum variance portfolio, and indifference curve concepts together explain how rational investors select portfolios aligned with their individual risk tolerance and financial goals. These principles form the core of modern portfolio theory and remain fundamental to institutional asset management, pension fund allocation, wealth management, and quantitative investment analysis. For CFA candidates, mastering Efficient Frontier concepts is essential for advanced portfolio construction and risk management applications.